Arbitrage and Volatility Trading Techniques by Chris Batista, John Rapone, James Cohen, Arian Munoz, Drew Bedard, and Thomas Doyle. Arbitrage in the securities market often connotates that one is buying something in one marketplace and selling it in another marketplace for a small profit while incurring little to no risk. The basic call and put are two of the simpler forms of option arbitrage. In these situations, the arbitrageur attempts to buy the option at a discount while simultaneously taking an opposite position in the underlying stock and exercising the option immediately to make a profit equal to the amount of the discount. Below, you'll see an example we have provided where the arbitrageur would make 8 points of profit from the stock, having sold it at 58 and bought it back at 50 via the option exercise. Dividend arbitrage is similar to the basic put arbitrage. The trader can lock in profits by buying both the stock and the put, then waiting to collect the dividend on the underlying stock before exercising said put. Below, we have included an example that shows you what dividend arbitrage is. The basic formula for a carrying cost is carrying cost equals strike times R times T, where R is the interest rate and T is the time the position is held. In an actuarial sense, the carrying cost could be expressed in a more complex manner due to the basic formula ignoring the compounding effect of interest rates and the present value concept. This is not necessary as the effect is not large on most calculations overall.
A conversation consists of buying the underlying entity and also buying a put option and selling a call option such that both options have the same terms. This position will have a locked-in profit if the total cost of the position is less than the striking price of the options. A reversal is exactly the opposite of a conversion, where the trader sells the underlying entity short, sells a put, and buys a call. A reversal will be profitable if the initial credit is greater than the striking price of the option. In both, the put and call must have synonymous terms. Most times, when one sells stock short, the trader must borrow the stock from someone who owns it. These stocks are usually found in margin accounts of a brokerage firm, earning this strategy the phrase using box stock, as margin account stock is generally referred to as being in the box. When a trader wants to do a reversal but does not have access to box stock, he will have to borrow from someone else. This leads to the stock loan business, where the trader will then have to pay anywhere from 10 to 20% of the prevailing carry cost rate. Although both conversions and reversals are regarded as riskless, there are some risks that are still prevalent enough to merit discussion. These risks are: an extra dividend is declared, the interest rate falls while the reversal is in place, an early assignment is received, and the stock is exactly at the striking price at expiration. It is apparent that a substantial portion of profits may be made from the interest earned on the credit of the position. The following is an example of this. To summarize, his loss on the security trades will be $25, the amount of time value premium paid for the call option. He makes 10 points by selling the stock at 60 and buying at 50, but loses $10.25 points on the exercise call. His overall profits will be $24.75. An arbitrage consists of simultaneously buying and selling the same security or equivalent securities at different prices. Thus, if one were to simultaneously buy a call, bull spread, and buy a put, bear spread, an arbitrage would occur. In essence, the trader is merely buying and selling equivalent spreads.
Other variations of arbitrage on equivalent positions are possible, although they are relatively complicated and probably not worth the time to analyze. An example would be one buying a butterfly spread with calls and simultaneously sell a butterfly spread using puts. A listed straddle could be sold and a synthetic straddle could be bought. Inversely, a listed straddle could be bought against a ratio. The only time the trader should even consider this is when there are more sizable markets in a certain of the puts and calls than there are in others. Arbitrage serves as a useful purpose in the listed options market because it provides a secondary market where one might not have otherwise existed. Equivalence arbitrage helps to keep the relative prices of puts and calls in line with one another and an underlying stock price as well. Risk arbitrage is a strategy that involves an arbitrage, same or equivalent securities bought and sold, but there is generally risk because the arbitrage usually depends on a future event occurring in order for the arbitrage to be successful. One form of risk arbitrage was described earlier concerning the speculation on the size of a special dividend that an underlying stock might pay. That arbitrage consisted of buying the stock and buying the put, when the put's time value premium is less than the amount of the projected special dividend. The risk lies in the trader's speculation on the size of the anticipated special dividend. Mergers are when separate companies agree to combine assets to become a new company. For example, Company A plus Company B equals Company C. Tender offers are another type of corporate takeover that falls under the category of risk arbitrage. A tender offer is when cash is offered for shares of a company, whether for some or all of the outstanding shares is up to the buyer's discretion. When acquiring or merging companies, the biggest threat is that said acquisition or merger falls through. This is because the falling through of a deal would result in losses on both puts and calls. The use of options through risk arbitrage is a way to minimize that risk.
Based on comparing today's implied volatility with one's expected volatility to do in the future, one's expectation for the volatility might be based on volatility charts, patterns of historical and implied volatility, Garge forecasting model. Volatility tends to trade in a group in the long run. Therefore, traders agree upon this approach. If implied volatility is low, then traders will usually buy it. If implied volatility is high, they'll sell it with caution. Volatility predictions. A prediction, as you know, is an estimated guess. There's two ways volatility predictions can go wrong. The first way is an outright prediction of volatility. This is when traders are wrong about the absolute level of volatility. This signifies that the implied is too low or too high. The second one is the path of their volatility predictions. Volatility skewed is usually an incorrect prediction about the way the underlying performs. Trading the volatility prediction deals with volatility from the viewpoint of the absolute level of implied volatility being quote-unquote wrong. This attempts to establish trade when implemented implied volatility is out of line. This is an attractive strategy. These are three ways that you can determine when your volatility is out of line. So the first one is compare implied volatility to its own past level, which this is considered the percentile approach. The second bullet is compared implied volatility to the historical volatility. And the last one is interpret the charts of the volatility. So these two methods are not as common as the other three. So the A compares current levels of historical volatility to the past measure of historical volatility, and B is using only a probability calculator. Now I'm going to speak about the percentile approach. This is used to describe just where the current implied volatility reading lies with its past values and measures what the options trading public is thinking about the volatility and comparing it to what they thought in the past. Comparing implied and historical volatility. This is actually the most common way that the traders of options determine which options are cheaper or expensive. The percentile of implied volatility is going to be affected by what the broad market is adding. Most underlying instruments would have a composite implied volatility reading around the 50th percentile. This is a continuation of the last slide, and traders should also be aware of the width of the implied volatility distribution. And advantage of buying options in a low percentile of implied volatility allows two things. The first thing is movement in the underlying, and the second is by increase in implied volatility. Reading the volatility chart. This is another technique traders use to determine if options are mispriced. In the reading, they said that this approach is definitely subjective. So when reading the charts, traders are looking for trends in the volatility to change. And the chart inserted is a volatility chart.
Comparing historical versus historical volatility levels. So comparing current levels of historical volatility with past with the past levels of the same measure is another method used to find options that align. This method is generally inferior because it doesn't tell us anything about option prices. This method is sort of backwards looking approach since historical volatility involves strictly looking at the use of past stock prices, no consideration of implied volatility in this approach. In addition, this method makes the assumption that a stock's volatility characteristics do not change. It will revert to some sort of normal past price behavior in terms of volatility. However, this is not true. All right, so selecting the strategy to use in buying a volatility. So a simple approach is best if one is buying volatility. When one is interested in the straight trading of volatility because he thinks implied volatility is at a line, only a few strategies will apply. If volatility is too low, then either a straddle or a strangle should be purchased. Normally, one would choose a straddle if the underlying instrument is trading near an available striking price. However, if the underlying is currently trading between two striking prices, then a strangle might be the better choice for the investor. A position trader would want to buy a straddle with 7 months of life remaining in order to improve their chances of making a profit. So in selling volatility, simplistically, a volatility seller would generally have a choice between one of two strategies. The simplest strategy is just to sell both an out-of-the-money put and an out-of-the-money call. The striking prices chosen should be far enough away from the current underlying price so that the probabilities of the position getting in trouble are quite small. A seller may want to try different strike prices in order to get a balance between a low probability of the stock reaching the striking price of the naked options and taking in enough premium to make it worthwhile. Merely selling a put and a call would mean that the options are naked. All right, so continuing with selling volatility, the next best choice of selling volatility is a credit spread. However, the problem with the credit spread is that one is both selling expensive options and also buying expensive options as protection. So an investor would need a lot of capital in order to use this selling option method. The result of volatility changes on the credit spread strategy results is if the volatility decreases, the profit to be realized by the credit spreader are quite small. However, compare this to a naked option seller where they would benefit to a much greater extent but bear the brunt of the losses. So the choice between naked writing and credit spreading should be made based largely on the philosophy and psychological makeup of the trader. So for example, does the trader feel uncomfortable with naked options, or does he have the ability to watch the market at all times, or does he have the financial capability to buy and sell expensive options? So now I have an example of using stock price history. So say a trader is considering to purchase of XYZ October 40 straddle for 11 points with the stock of 39.60. The options are cheap at the time and the probability of success appears good according to the probability calculator. The question that now needs to be asked and answered is this: in the past, has this stock been able to move 11 points in 10 months? Or more importantly, since 11 divided by 39.60, the stock price is about 28%. Has the stock been able to make moves of 28% over 10 months in the past? The answer to these questions can be readily obtained if the stock price history is available. So this answer can be expressed in the form of probabilities, much as the result of the probability calculator are. So if the trader were to determine that the stock has been able to move 11 points in 10 months, only 77% of the time, this is okay option for the trader to make. However, if the trader were to determine that XYZ has been able to move 20% in 10 months over 90% of the time, this would be a much more enticing straddle to buy. So another approach used in buying and trading volatility. So use the past movements exclusively and ignore the other analysis altogether. So if the study of past movements tell us that a stock has a good chance of moving 18 points, an investor doesn't care about the relationship of implied and historical volatility, or what a theoretical probability calculator might say, one would have a mindful of not buying overly expensive options or selling overly cheap ones because implied volatility cannot be ignored.
After the stock market crash in 1987, index options experienced a permanent distortion. Out-of-the-money puts remain more expensive than out-of-the-money calls, and furthermore, out-of-the-money puts are more expensive than at-the-money puts, and out-of-the-money calls are cheaper than at-the-money calls. This distorted effect had several causes and would later be given the proper name of volatility skewing. The proper definition for this phenomenon is the long-lasting effect whereby options at different striking prices trade with differing implied volatilities. So now I'm going to go over the volatility skew strategies. The first strategy is a simple bear spread, and it benefits from volatility skew, but it isn't a neutral strategy, and it requires that the underlying drop in price in order to become profitable. The second strategy is to buy puts and sell a larger number of out-of-the-money puts. This is also known as the ratio spread strategy, and it's best suited for moderately bearish investors. And severe market decline might drive index down so low that the additional short puts could cause significant financial losses. The third strategy is to sell calls and buy larger numbers of out-of-the-money calls, also known as the back spread strategy, and this works best for bullish investors. In theory, a trader could implement the back spread and ratio spread methods simultaneously to give them an edge over a wide range of index prices. Volatility versus arbitrage. Calls and puts at the same strike price must trade for the same implied volatility, or else conversion or reverse arbitrage would eliminate the difference. However, there is no true arbitrage between different striking prices. Therefore, arbitrage cannot eliminate volatility skewing. And I'm just going to go over a quick summary of volatility skewing. Advantages when volatility is skewed arise from the fact that normal market movements are different from what the options are implying. The options are wrong when they're skewing at all strikes from lowest to highest. Volatility skew can change in time, so a trader should be cautious projecting profits prior to expiration. At expiration, the volatility disappears, so traders planning to hold the position to expiration will find that volatility skewing presented them with the opportunity for a positive expected return.